for Rigetti Computing, ticker RGTI.
A very sharp move.
We're talking about an 8.69% slide down. It closed the session at what, $22.38?
That's right. And look, for most people, seeing a stock you're watching, or worse, that you own, lose almost a tenth of its value in a day, that's an instant trigger for panic.
It absolutely is. You immediately start looking for what went wrong.
Exactly. A frantic search for bad news, a failed contract, a technical glitch, a guidance revision, something.
But the source material for our deep dive today, this really focused investment analysis report, it's titled RGTI, the negative 8% D-drop you've been waiting for. Buy alert. And it takes that fear and just completely flips the narrative.
It reverses it entirely. And that's our mission here, to really analyze this report.
It's intensely contrarian, aggressively bullish.
It is.
And it argues that this $2.13 slide isn't a disaster, but a golden entry.
Which is. It's a bold claim. So we need to figure out, for you, the learner, why this analysis would look at a major drop and call it a GIF.
That friction, right, that tension between the market fear and this kind of analytic optimism, that's where the real insight is.
That tension is key. We're going to look really closely at the reasoning here because the analysis, it encourages you to think critically.
About what specifically?
Well, why a steep market drop might not signal fundamental weakness at all, but instead maybe it represents a temporary, almost mechanical opportunity.
Created by market forces.
Exactly.
So let's start with the event itself. RGTI closes down at $22.38.
An 8.69% hit?
When the market delivers that kind of hit, the psychological pressure is enormous. You immediately think the company did something wrong.
And what's fascinating here is that the report, it just explicitly and forcefully rules all of that out.
All the fundamental causes.
All of them. The analysts assert this drop was not triggered by bad news. They say there were no failed earnings, and this is crucial, no reported issues with the company's core quantum technology.
So the distinction they're making is vital.
It is.
Because their reasoning is purely seasonal and mechanical.
Right. They attribute it to what they call classic holiday low-volume profit-taking.
I love the metaphor they use, the Santa hangover period.
It's a great one. It perfectly characterizes that usual year-end selling pressure.
And that low-volume component is why the percentage drop looks so scary.
Right. That's the key. If there aren't a lot of buyers just sitting there waiting to absorb the shares being sold,
then even a little bit of selling can cause a big price swing.
A huge price swing. The analysis characterizes it as traders who, they rode the stock from maybe $15 up to $30 and are just cashing out before the new year.
So it's defined purely as money moving around.
That's it.
It's not a reflection of the company's health or its tech progress.
And for you, the long-term investor, this is the distinction you have to remember. If the cause isn't fundamental, if it's just about liquidity and timing,
then the analysts are seeing it as a temporary discount.
A sale on the company's future, not a permanent problem with its value. And this point is absolutely crucial.
Because
it means we have to immediately pivot our attention away from all that market noise and look toward the core reason anyone owns this stock in the first place.
The massive future potential.
Exactly.
Okay, here's where it gets really interesting. The whole contrarian thesis, it depends entirely on the strength of that underlying growth story.
It has to.
The report defines Rigetti as a high beta play.
Meaning it's expected to move much more aggressively than the market, both up and down.
And it's targeting these huge future markets. We're talking AI and defense, all driven by quantum computing.
And this brings us to the core valuation argument, which is really the heart of the bullish case.
Right.
The analysis is very clear that Wall Street is not valuing RGTI on today's revenue.
Which they cite at.
What was it? A pretty modest $1.95 million. If you only looked at that number, the stock price would look completely insane.
That's the paradox right there. So instead of today's sales, the valuation is all about a forward-looking expectation.
100%. Specifically, the company's 2026 roadmap.
It's a pure play on future potential.
You're betting that Rigetti will be a leader in quantum computing, a field that, everyone expects to be transformative.
Especially for defense and complex AI simulations.
Right. The valuation gap, that difference between, say, $1.95 million in revenue and a multi-billion-dollar market cap, that is the risk you take.
For the massive potential payoff.
If the roadmap succeeds, quantum computers can solve problems that are just. They're impossible for even the most powerful supercomputers we have today.
In that context, that helps explain the really aggressive analyst targets they cite.
It does. They give you hard numbers to back up the upside. Wedbush, for example, has a $35 price target.
And the report goes on to say that some street highs are even sitting at $50 plus key.
And if we connect this to the bigger picture, those targets really put the risk-to-reward ratio into perspective. Well, the report argues that buying today at this $22 level and aiming for that $35 target, That's almost 60% upside.
And compared to buying it just a week ago at $24, $25.
The risk-to-reward ratio, and I'm quoting them here, just got a whole lot sweeter.
Wait, let me just introduce a critical question
Let's for it.
because this is what you, the listener, need to think about. If the entire thesis is built on a 2026 roadmap, how does the report protect against the market just deciding that, you know what, $22 is actually a fair price for a company with such low sales right now?
That's a really important question. And the report, it kind of addresses it by framing the trade around market timing and technical support, which we'll get to in a second.
Okay.
The thesis is basically that the market already prices in the massive failure risk. That volatility is baked in.
So when a dip happens, that isn't fundamental.
It's an opportunity. It's a chance to get the same high-risk, high-reward potential, but at a lower cost. You're leveraging a temporary market inefficiency.
Okay, so the long-term potential is the rocket fuel tied to that 2026 promise.
For sure.
But if you're going to act on a dip like this, you need to know if the short-term technicals support the launch pad. What does the report give us, technically?
This is where it gets really actionable. They lay out two critical price points, two floors.
Okay.
The first one, the immediate level, is $22. They call that the psychological floor.
And it's pretty relevant that the stock actually bounced today right off $22.33.
Very relevant. It shows there was active buying resistance right there.
And then there's the really aggressive level.
Yeah, $20. They use that classic industry term, the back up the truck zone.
And for those unfamiliar, that just means?
It means the analysts believe this is the highest confidence, best possible price. The moment where you invest the most you can because the risk seems lowest and the upside is maximized.
So beyond just price floors, what other indicators are they looking at?
They look closely at the moving averages. They note that the stock is currently trading below its 50-day moving average.
And for you, the learner, think of that just as the short-term trend line.
Right. And when the stock dips below it, the report suggests it usually acts as a magnet.
A magnet.
Yeah.
Implying a return trip back above that average is likely.
It's highly likely in the short term, yeah. It confirms the temporary nature of the drop. Like it's just pulled down by a temporary gravity and not a real structural weakness.
And they frame this whole pattern historically, too.
They do. The analysis argues that an 8 to 10% cool-off in a single day during a strong bull market, especially for a stock like this.
It's often just a shakeout.
It's a shakeout event, a mechanism to force out the short-term traders, the people who panic easily, right before the stock starts its next big move up.
That makes sense. The market washes out the weak hands before the real rally.
Exactly.
But what's the specific catalyst the report sees for the rebound? They're predicting a V-shaped recovery.
A sharp drop followed by an equally sharp rebound. And the primary catalyst they cite for this is the influx of fresh money next week.
And to clarify a point that might be confusing,
Go ahead.
the report mentioned January 2026 for the roadmap, but this fresh money reference is about the start of the new calendar year, right? This coming January.
Yes, that's a great clarification. This is the classic January effect. New investment capital, annual bonuses, institutional money getting reallocated. It all starts to hit the market.
So you get new capital flowing in right as that low-volume profit-taking stops.
It's a fundamental shift in liquidity. And the analysis suggests this new capital will be looking for beaten down, high-potential names, just like RGTI.
Triggering that V-shaped pattern they're predicting.
That's the core of their short-term timing argument, which, it raises an important question for you to consider.
Which is?
While this expectation of fresh capital in January is pretty standard, how much weight should you really put on that versus the need for a truly fundamental, positive piece of news to drive the stock?
The report seems to think the capital inflow is enough on its own.
They do. They believe it will be sufficient.
So what does this all mean when we put it all together?
I think the core wisdom here is to view volatility differently.
You mean don't let a red day, even an 8.69% red day, cause you to panic out of a position?
Not if that position is built on a high-confidence, long-term green thesis, like this 2026 roadmap.
So the report's core message is that Rigetti is and will remain volatile.
It is. And that volatility is simply the price of admission for the massive potential gains.
The analysis strongly encourages viewing this dip as a necessary temporary part of the process, not a reason to be anxious.
Absolutely. It's an ingredient for potential upside.
And they summarize it perfectly with that final metaphor, right? Aimed straight at the investor who's been waiting on the sidelines.
If you were waiting for a pullback to either start or add to your position, this is it.
The analysis concludes that the bus has backed up to the station.
You now have the chance to board right around that critical $22 floor.
And potentially right before that V-shaped recovery, driven by new January capital, takes hold.
And that leads us to a final thought for you to explore. Given that the entire bullish case for those aggressive $75 or even $50 price targets rests squarely on the success of that 2026 roadmap, What specific milestones would Rigetti need to hit in the near term?
What kind of milestones?
I mean, major technological breakthroughs or, say, governmental contracts, something related to high-performance AI or defense systems.
So you should focus your research on those concrete steps.
Exactly. What are the steps that would accelerate the movement away from this $22 support level and fundamentally prove that the 2026 roadmap is actually on track?